When was the last time you paid for something with cold, hard cash? While physical currency is still widely used all around the world, people in some countries have been using it a lot less lately, and Americans may be next. The United States dollar is facing a major crisis. The country is on the brink of issuing a digital dollar, which differs from traditional money in many ways. The US dollar has held a monopoly of global trade for decades, but that's changing. China is leading the way, but there are other countries that are following suit. If you want to stay ahead of the curve in this situation, it is now time to think about how you should handle your money. The US government has created a new digital currency, which has changed the way we use money and how we view it. The new currency has brought with it a lot of uncertainty and warning signs for those who use the US dollar. It is essential to understand the implications of this new digital currency and what it might mean for our future financial stability. The financial and economic world has been largely influenced by the invention of the United States dollar. As the unofficial global currency, it has been used in almost every sector of international commerce over the decades. However, the Federal Reserve just confirmed that it plans to roll out its FedNow offering. It is a real-time payment service that will provide another option for instant payments in the United States. The Fed says on its website that the service, which is scheduled to launch in July, will let money be transferred from the account of a sender to the account of a receiver in near real time and at any time, any day of the year. While the U.S. already has a real-time payment option that's run by the Clearinghouse, a bank-owned association, FedNow will serve as another choice for businesses and consumers. Now, many are wondering how this could even affect their day-to-day life. While citizens subject to central bank digital currencies could face a number of risks, including ramped-up government surveillance, data theft, and even financial punishments for political dissidents. As the world increasingly moves towards a digital economy, it is important to understand the difference between digital currency and traditional currency. Central bank digital currency is generally defined as a digital liability of a central bank that is widely available to the general public. Today, in the United States, Federal Reserve notes physical currency is the only type of central bank money available to the general public. Like existing forms of money, a central bank digital currency would enable the general public to make digital payments. A variety of recent digital disruptions, including the emergence of cryptocurrencies and blockchain technology, have made waves in the financial services sector. Digital currencies are part of that story, and central banks have started to take note. At this current moment, there are 87 countries, representing more than 90% of global GDP, that are exploring central bank digital currencies. These include economic giants like India, Brazil, and the Eurozone. In the United States, the Federal Reserve Bank of New York is now testing out the concept with major banks. Central bank digital currencies are the digital form of a government-issued currency that is not pegged to a physical commodity. They are issued by central banks. Examples of central banks include the U.S. Federal Reserve System, the Bank of Japan, and the People's Bank of China. Central bank digital currencies are similar to, but not the same as stablecoins. Stablecoins are a specific type of private, stabilized cryptocurrency pegged to another currency or financial instrument, with the goal of maintaining a relatively stable value over time. Unlike cryptocurrencies, which are decentralized, central bank digital currencies are state-issued and operated. So it may seem enticing to ditch a physical currency, especially considering the boom in cashless businesses and the crisis-induced cash shortage. But many experts have also highlighted a number of downsides. and each country has plenty of leeway in designing its own. Plenty of people already pay digitally. This year, around 41% of Americans ditched cash for their weekly purchases. That is up from 24% in 2015. While estimates vary, up to 60% of China's purchases are now cashless, driven not just by credit cards, but also by mobile payment apps like WeChat Pay and Alipay. Historically, central banks have issued currency. Cash is relatively anonymous after all. But with a central bank digital currency, that layer of being anonymous would likely disappear. Security advocates have pointed out how a government could theoretically track all of its citizens' purchases and gain intimate knowledge of someone's daily activities. And while central bank digital currencies could afford users privacy by making some low-value transactions anonymous, legal restrictions in many countries make anonymous central bank digital currencies basically impossible. Then it's theoretically possible for the authorities to monitor what people are doing with their money, coerce them into spending on certain things, or even target individuals based on their spending. For example, the Canadian government froze the bank accounts of people who protested mandates in 2022. Officials had to work with commercial banks to make that happen, but central bank digital currencies could eliminate that hurdle. This means that politicians could more easily mess with the accounts of many individuals. Now, one of the biggest questions is, what are the different types of central bank digital currencies, and where are they currently in use? Right now, there's no one type of central bank digital currency. A wide variety of approaches are being piloted in various countries. One type of central bank digital currency is an account-based model, such as Dcash, which is being implemented in Eastern Caribbean. With Dcash, consumers hold deposit accounts directly with the central bank. At the opposite end of the spectrum is China's eCNY, a central bank digital currency pilot that relies on private sector banks to distribute and maintain digital currency accounts for their customers. China showcased the new currency during the 2022 Olympic Games in Beijing. Visitors and athletes could use the currency to make purchases within the Olympic Village. Another model is one under consideration by the European Central Bank, in which licensed financial institutions each operate a permission node of the blockchain network as a conduit for the distribution of a digital euro. Jamaica's JAMDEX launched in June 2022 and is the first central bank digital currency to be ratified formally as a legal tender. JAMDEX is not blockchain-based, unlike the Bahamas Sand Dollar and the Eastern Caribbean Central Bank's Dcash. Nigeria was the first African country to roll out a central bank digital currency. Sub-Saharan Africa is also poised to adopt central bank digital currencies. Project Aber is an initiative launched jointly by the central banks of Saudi Arabia and United Arab Emirates that tested the use of jointly issued digital currency as an instrument for domestic and cross-border settlements between the two countries. But why have central banks become interested in central bank digital currencies? Well, there are 4 trends that have likely spurred central bank interest in central bank digital currencies. First is plummeting cash usage. In Europe, cash usage declined by 1/3 between 2014 and 2021. In Norway, only 3% of payment transactions are made with cash. This trend has forced central banks to re-examine their role in the monetary system. Second is their growing interest in privately issued digital assets. In the United Kingdom, 10% of adults report holding or having held a digital asset, like cryptocurrency. The European Central Bank says that as many as 10% of households in 6 large European countries own digital assets. Third is a decreasing sense of central banks as payments innovators. Central bank digital currencies offer central banks a new opportunity to lead strategic conversations on cash use cases in a public forum. And lastly is a rising global payment systems. Many central banks seek to establish greater local governance over increasingly global payment systems. Central banks see CBDC as a potential stabilizing anchor of local digital payment systems. For now, major powers like the Central European Bank and the Federal Reserve are still figuring out how to address the rise in central bank digital currencies. The Federal Reserve Board has issued a discussion paper that examines the pros and cons of a potential U.S. central bank digital currency. Speaking before the House Financial Services Committee earlier this month, Fed Chairman Jerome Powell said, "The central bank was not close to releasing a U.S. central bank digital currency." Jerome Powell has implied that stablecoins could fit into the traditional banking system, but Powell reiterated that more regulations and safeguards were needed for digital assets. Another member of the Fed Board of Governors, Michelle Bowman, said last year, "Fed now addresses the issues that some have raised about the need for a central bank digital currency." The proposed benefits of central bank digital currencies could just as well be accomplished by making existing options easier and cheaper to use. Overall, digital currency in countries where significant amounts of people do not have a mobile phone or internet access in the first place could be useless. Now, I would love to hear your thoughts on central bank digital currencies in the comments section below.